Okay, so now you've learned a little bit about what a T account is, which is a simple ledger, and then debit credit theory. And I hope that you've put to memory that chart from lesson 4.2, where it provides the basics of debit credit theory, where assets show an increase on the debit side, a decrease on the credit side, liabilities and owner's equity, an increase on the credit side, and a decrease on the debit side. So hopefully you've put that to memory, or at least you have a little cheat sheet that you keep with you as you work through your assignments. So now that we're able to record transactions now in the T accounts in the ledger, we need to calculate the new account balances. So we need to figure out what is in the cash balance, how much money is in the cash balance, how much do accounts receivable owe us, how much supplies do we have on hand. And so let's go through that now in 4.3. So here is the ledger, and this is the same ledger that we worked on the other day in 4.2, where we recorded those transactions. And so these are all our transactions recorded. So I want you to make note first of a couple of things. So our opening, sorry, I've got this upside down, hold on, moving my bamboo. Okay, so over here we have our cash, our opening balance is $3,000 here, $3,265. And so all of the opening balances are in blue here. And then we have our transactions. And so transaction number 1 was that we purchased some supplies. So we debited supplies and we credited our accounts payable here, which is Packham Products, because we didn't pay for the supplies right away. So that's that first transaction. And so on. We have another transaction here where it shows that we've paid off one of our accounts payable, Dini Brothers. So we've reduced cash by crediting cash, and that's transaction number 2. And over here you can see the debit, where we're reducing how much we owe Dini Brothers by $500 by debiting that account. So now what we're going to do is we're going to look at the steps on how to calculate the balance of each account. So calculating the balance of each account, the first thing you're going to do is you're going to add the two sides. So you're going to add the debit side and the credit side of the accounts separately. That's very important. And you're going to write the balance of each side beneath the last item on each side. The next step is that you're going to subtract the smaller total from the larger total. So I'll show you that in a second, and we're going to record that value under the larger total. So we're going to record the amount that we calculate under the larger total. And finally, we're going to circle the final amount. Okay, and we want to do that so we can show that that is the balance, so that people aren't confused about what balance we're talking about. So for instance, in cash, so what we're going to do is we're going to draw a line here, okay, and we're going to total up each account. So the first thing I'm going to do is I'm going to total up the debit side, oops, except for I have to type in the numbers properly, 3265 plus 200 plus 400, and that gives us 3,865. So over here we're going to write 3,865. I'm a little messy, so hopefully you're not this messy. Then we're going to calculate the next side, and we're going to calculate the total on the other side. So on the credit side, 500 plus 2,500 plus $650, and that equals 3,650. So on this side here, we're going to write 3,650. So now our next step is to take the larger value, 3,865, and subtract the smaller value, and that's going to give us $215, and we're going to write that number underneath the underneath the larger total. So, oops, I'm pushing the button here. $215, and we're going to circle that, and that's our final total. So these here are called pencil footings. Okay, these balances, these calculations that we've made are called pencil footings. And it's just because they're the subtotals of each side. And then this is our final balance. We circle it, and this is what's going to appear on the balance sheet. So this now goes to the balance sheet when we're completing the balance sheet. We don't have to do anything with W. Caruso, our accounts receivable, because there was no transactions that affected this account, so that's the final total. On this side here, these ones are fairly easy, so we can say this is $970. Oops, I'm pressing a button. Hold on. $970. And this side is $200. We take the larger number, subtract the smaller number, and we get 700. Oops, 770. And that's our final total, and it's a debit balance. The reason we write it underneath the larger number is it tells us which side it is. So this here, cash balance, is in a debit position, so we're going to write it under the debit side. This accounts receivable here, 970 is the larger value, which means we're going to have a debit balance. That's the larger number, and we're going to write that value on the debit side. The bank loan hasn't changed at all, so that's a final total. On this one here, we'll do a calculation again. So we'll take 1516 plus 5500, and that equals $7,016 on this side. And we have 500 here. We don't have anything to add to it. And so then we take 7,016 minus 500, which is $6,516. And again, I circle it. It's a final total. On this one here, Packham products, we just have a credit entry on here. So this number is going to be 4,146 when we add those numbers together. There's nothing on the debit side, so we don't have to subtract anything from it. Same with supplies. It just has a debit entries, so we're going to add them together. 2,665. Oops. I don't know what I'm pressing, but there. That's a final total. We have our trucks, and we purchased an $8,000 truck, so this is going to be $63,075. When we add those two numbers together, we circle that. Equipment stays the same. It has a debit entry of that. And then our capital, and we'll add up our capital. So on the debit side, we have $650. And on the credit side, we have $60,287 plus 400 plus 350, which equals 61,000. Oops, I didn't even catch that. 61,000, oh, I don't remember. Oh, 9. Okay, so then we take that value, the 61,037, and we subtract the 650, which gives us a total of 6,000. Oops, back it up. Sorry, I have to do that one again because I hit something. 60,387, 60,387, and that's a final total on the credit side for capital. So these values, these circled values, will all show up on the balance sheet, and we still want to make sure our debits equal our credits. We're going to learn that in the next lesson in 4.4, but this is how we calculate final totals in our T accounts. Hopefully yours look nicer than mine. So this is the balance in each of the ledger accounts, and the side it is written on represents if it is a debit balance or a credit balance. So the side it's written on, if it's under the larger number, the side it's written on represents if the account has a debit balance or a credit balance. Usually assets will have a debit balance, liabilities will have a credit balance, and owner's equity will have a credit balance. We also want to make sure that debits equal credits in our T accounts, and we're going to do that in lesson 4.4. So sometimes, I said they usually have those kind of balances, but there are situations where sometimes an asset account might have a credit balance or a liability might have a debit balance, so opposite from what they normally would have. Examples of situations that would occur like this is if a business takes out more cash than is in their bank account. So sometimes the bank will allow the business to go into something called overdraft. And it allows us, so if their balance in the bank account is $500, but they write a check for $800, then it's allowed to go into a credit position of $300 for a short period of time. So this is in a credit position for cash. So sometimes that will happen. So this is called overdraft, and cash accounts are allowed to go into the negative position, into a credit balance for a period of time. Sometimes a business will overpay in accounts payable. So if they regularly pay one of their accounts payable, like let's say Bell Canada, and they accidentally overpay them more than they intended, they wrote the check for more than they should have, then it will end up with a debit balance for a short period of time. It'll fix itself the next time we write a check. These balances don't usually have an exceptional balance for very long. They usually correct themselves and become normal again in a short period of time. So assets will go back to a debit position and liabilities will go back to a credit position. So the next part is that you've become somewhat accustomed to some of this terminology in terms of interpreting transactions when you see the words on credit. So let's talk about that for a second. Buying items and selling items on credit. When a business buys from another business, they are usually given terms that allow them to pay for the goods at a later date. Okay, so at a date later than when the sale took place. Here's some terminology that you need to know as we continue to investigate transactions. So sometimes a business will purchase on account. What this means is that items are received from a supplier but are not paid for. So we've received something from a supplier, some inventory, but we haven't paid for it yet. So that entry is always going to be this. We're going to debit the asset, whatever it is that we purchased, and we're going to credit the accounts payable. This is a given. Anytime we buy on credit, we're going to credit accounts payable. When there's a sale on account, meaning that we've made a sale to a customer, but we haven't required the customer to pay right away, so there's a sale on account. These are items that are sold, but the customer will pay later. So customer pays later. So in this situation, we're always going to debit accounts receivable, and we're going to credit capital. The next one is payment on account. So sometimes the business will make a payment that was on account. What that means is that they've paid money to a creditor or an accounts payable. That entry is always going to be the same. We're going to debit our accounts payable and credit our cash. We're going to reduce our accounts payable or debit our accounts payable, and we're going to credit cash because cash goes down as well. Sometimes we'll receive money on account, and that's called receipt on account. So from a customer that has paid a debt that they owe to us, so an accounts receivable has paid part of their debt, that's called a receipt on account. And in that situation, the entry is always the same as well. We're going to debit cash, and we're going to credit accounts receivable. So cash goes up, and accounts receivable goes down because they owe us less money now. What I've done here is I've provided you a chart that says the same thing that we just looked at, but it's showing it using T accounts. Okay, so you can see the debits and credits for each situation: purchased on account, sold on account, paid on account, and received on account. So now it's your turn. I've given you 4 transactions where you need to record the debit and credit for each situation, A, B, C, and D. Make sure you get this done, and I'm going to check it when we have our class.